In this week's video, we'll review the latest charts to help us answer the question, will Fed tapering bring major investment shifts? This portion of the video is being recorded around 2:15 p.m. on Friday, October 29th. Many of the charts used in this week's video are from Thursday's session, October 28th. Nothing that's happening in Friday's session changes any of the commentary that follows. During the session on October 29th, both the S&P 500 and the NASDAQ were hovering right around new all-time highs. Growth was beating value. The NASDAQ 100 was beating value. Tech was beating value. Large cap growth was beating the market. The market was beating small caps, and small caps were outperforming mid caps. The Federal Reserve will most likely announce the long-awaited taper schedule at the regularly scheduled meeting on Wednesday, November 3rd. Tapering will most likely begin later in November or in the month of December and take the form of a $15 billion a month reduction in asset purchases. That tells us that the taper would most likely end around mid-year of 2022, most likely in the month of June. The Fed has been telegraphing their intentions for several months, and thus, most likely, there will not be any major surprises related to the taper schedule. Thus, the most important topics in next week's meeting may be related to the Fed's expectations about inflation. We covered this chart of the S&P 500. It's a monthly chart with the 10-month moving average shown in blue. We covered it in detail in the October 8th video. And in that video, we noted that despite the weakness in the month of September and early in October in the S&P 500 this year, the present day still looked a lot like a favorable and bullish period relative to a concerning and bearish period. If we fast forward to October 28th, we can see the monthly chart. We're well above an upward sloping 10-month moving average. It appears likely that we'll get a monthly close above that 10-month moving average. And in that same October 8th video, we covered this chart in the center of your screen, S&P 500 as of October 6th. Here's the decline that started on September 2nd. We were still near the lows on October 6th. And the purpose of looking at charts like the one shown on your screen was to determine if the present day was starting to morph into something more concerning like this, or this. If we fast forward to October 28th and look at the same chart, we have that full-bore bullish look back, and the S&P 500 has printed a new high above the September high. Just as a chart like the one shown on your screen was helpful during the decline in September and October, in the future it most likely will be helpful again. You can see the look over here on the right side of your screen really doesn't look anything like this concerning spike in the early stages of the COVID plunge. The same thing can be said for this decline in Q4 of 2018 and this decline in Q1 of 2018. During the correction in the S&P 500 that lasted from the close on September 2nd until the close on October 4th, charts like this were extremely helpful. Here's another one that we've been monitoring for some time. You can see a spike here in the early stages of the COVID plunge in the Ridex ratio. Look at recent months over here. It really doesn't look anything like this concerning spike here in 2015 before the market had a lot of problems in here and did not bottom until February of 2016. An updated version of charts that we've covered many times, the one on the right is as of October 28th. We just never really saw, or at least haven't seen it yet, a concerning plunge like this or this. Very, very similar situation here. Are we seeing some slowing momentum in this area? Absolutely. Have we rolled over like this or this? We didn't in September. We didn't in early October. Doesn't say anything about what's going to happen next, but the chart in front of us still looks pretty good today relative to this and this. This one's not even close. October 28th on the right side of your screen, Here's where the S&P 500 peaked in early September. We consolidated, and for the most part, we're printing higher highs, and we just printed a new high for the rally off of the March 2020 low in the S&P 500. We printed that new high on October 28th. You can see in 2020 we have consolidation in here where my cursor's moving around. We have consolidation in the present day. It hasn't rolled over, but we would like to see some improvement here. Like to see something more like this in the coming weeks. Typically, maximum fear in the markets is a deflationary event. You can see we consolidated in here in the present day for several months and then broke to the upside in the August-September window. You can pause your video player here, but this is the October 1st video, September 21st tweet. We looked at the same chart here. We were looking for this momentum to dissipate over time. And that's exactly what happened between September 20th here and let's say about October 14th. Typically wouldn't use a chart like this, a 30-minute chart, relative to our time frame. But when the market's weak, as it was in this area here where my cursor's moving around, it can be helpful to look at shorter time frames to see if the market is trying to right itself. Chart we've covered in a recent video dated October 14th. This was a little bit of a bullish divergence here relative to the S&P 500. You're closer to making a new high up here relative to here. If we fast forward to October 28th, we've now broken out of this multiple month consolidation box where my cursor's moving around up here, and the S&P 500 has followed suit by printing a new high above the September 2nd high. As always, the longer a breakout holds, the more relevant it becomes. NYSE new highs minus new lows. You can see they start dropping significantly in the early stages of the COVID plunge. The S&P 500 peaks on February 19th, and soon thereafter, breath starts to deteriorate in a very, very concerning manner. This steep red slope here is fear. It's increasing fear. You can see we really don't have anything like that up here. We do have a hesitation and a stall. And here's where the market really started to take off, especially from a confidence perspective, in early November of 2020. You can see the slope turn up. This is the zoomed in look here. It has been improving since the market bottomed. As always, doesn't say anything about what the chart's going to look like tomorrow, but thus far, this is what we would want to see off of the October 4th low. Similar concepts here, covered it on October 15th. We said there was a lot to learn about price action up here in the upper right-hand corner of your screen relative to price action here. If we fast forward, now it looks like we have consolidation, upward sloping 200-day moving average, price holds here. We've recently printed several multi-month new highs above this consolidation area here. If we trade the chart in front of us, meaning we analyze what we have in front of us, we don't try to predict what this chart's going to look like tomorrow. There's really not any discussion here. The chart looks better today than it did back on October 13th, the chart we covered on October 15th. Another chart that we covered on October 15th here, we said the pullback in the NASDAQ 100 for the most part looked like a normal retracement even of this very short-term move from point A in May of this year to point B here in September. That's what fibs help with. The fibs tell us this is a bullish move. This is a normal retracement in the 38.2, 50, and 61.8. Nothing magical about them. They just help us with probabilities. So when the market was down here on October 4th, we were sitting between the 38.2 and the 50% retracement. Fast forward to the 28th of October, and it looks like we're trying to resume this short-term bullish trend that is part of a longer-term bullish trend that began at the March 2020 lows. October 15th video, we said the present day right now looked more like the rally here where my cursor's moving around relative to this look, this look, this look, and this look. If If we look at the same chart on October 28th, it's a weekly chart here, but right now if we closed on Thursday, we'd be printing a new weekly high, and we held above the Bollinger Band center line, which is in sharp contrast to this look here or this look here. Here's another one where you can pause your video player and take a closer look at this chart. This is NYSE advancing minus declining volume. It's a monthly chart. All things being equal, this is the rally from 2004 into almost 2008, and you can see we stay above an upward sloping center line. Typically, if you start to drop below the center line, concerns start to increase a little bit relative to the S&P 500. Point of the exercise here, during the recent pullback, we never came anywhere close to the center line down here. And maybe more importantly, it's not unusual to get periods of consolidation and then breakouts. This looks somewhat like a period of consolidation. So here's your box right in here. This is a bullish breakout. The recent weakness, it looks like this is now somewhat of a retest of the breakout here. It looks like we're trying to bounce right here at this level here. What once acted as resistance may now act as support. Right now, the chart in front of us, this looks constructive. Very, very similar concepts here. Compare and contrast this consolidation, this breakout here, the fact that the ratio is well above this 2020 peak here. Contrast the look in here where my cursor's moving around with this look over here during the COVID plunge in the S&P 500. This is somewhat of a noisy chart here, but it's very, very easy to understand. This is SPY relative to TLT or long-term treasury bonds in the ETF world. We're looking at the 10 trading day, 15 trading day, 20, 12, 25, and 30 trading day rate of change. We're seeing something different relative to what we've seen in recent months. Every single one of these readings is now positive. That was not the case in this window here, and this aligns with this consolidation period and what appears to be a bullish breakout and somewhat of a retest look right here relative to these levels back here. As always, the longer we stay above zero on these readings and the longer the breakout holds, the more meaningful it becomes. It's a little easier to see here. We have 5 months of consolidation and what appears to be a bullish breakout. If we look at a high-low close bars, you can see the ratio started to run away from an upward sloping 200-day moving average in red. This appears to be sideways consolidation, somewhat allowing the 200-day to catch up. Thus far, we've held that upward sloping 200-day moving average or the longer-term uptrend. We have the breakout. Now this looks like a retest Wednesday of this week. We're retesting this level. The weight of the evidence says most likely this is going to hold. If it doesn't, and we move back into this area down here, we'll learn something about increasing bearish probabilities. Notice here where SPY-TLT is, well above this May high over here. That's not the case as of October 28th. Here's the May high for equal weight RSP, the equal weight S&P 500 relative to TLT. From a leadership perspective, it's very, very difficult to say your leader is RSP at this point over SPY. SPY has the bullish breakout and has exceeded these highs. Right now, RSP would be a laggard on that front. Obviously, that's subject to change, but we're making comments about the charts in front of us. This is the NASDAQ 100 triple Qs relative to long-term treasury bonds TLT. MACD, what it tells you is, here's the zero line for MACD where my cursor is. When black MACD is above zero, it means you're in an uptrend. When black MACD drops below zero on a weekly basis, you're in a downtrend. Notice here when we get the bullish cross with black going over red in February of 2019, same with this bullish cross here and this bullish cross here after the COVID low. all of those occur below the center line, telling us somewhat we've still got an equal battle in here and no clear trend. The bulls start to win a little bit more when black gets above zero. Point of the exercise here, unlike this bullish cross, this one and this one, we're trying to form one now above the zero line. And that speaks to possibly resuming this uptrend. This is more powerful here than this cross here in terms of somebody winning and losing on a longer term basis. You can think of it this way. This is an uptrend. This is a counter trend within the context of an uptrend. If we get a bullish cross and morph back into this, we would be resuming the uptrend. And that's exactly what it looks like when we look at price. Compare and contrast bonds, IEF. Now we're looking at intermediate term 7 to 10 year treasury bonds. That's shorter term relative to TLT versus SPY, the S&P 500 ETF. Here's the COVID fear spike here. Contrast this look here with the bearish breakdown in the ratio that occurs in early November of 2020. It's pretty easy to say this look here looks a lot more like the present day relative to this look here. If we're expecting the present day rally to mimic or mirror the rally from early November to, let's say, February of 2021, this move here, that's not really what we have on a lot of charts. It looks different. Notice here, price, or the ratio in this case, which is the total stock market, VTI, relative to SPY. We have a full-bore bullish look on November 1st. Price is above all of the moving averages. The slopes, for the most part, are all up. Blue, the fastest moving averages on the top, and red, the fastest moving averages on the bottom. Contrast that with where we are in the present day. We're closer to a full-bore bearish look here. And notice on November 1st, the ratio is well above a flattening and starting to turn up 200-day moving average in orange. Look at the look of the 200-day today. It's flattening and looks like it's trying to roll over, and price is below it. This chart speaks to asset allocation. It's telling us if we're going to try to follow the blueprint from November 1st into, let's say, mid-year, that's really not what we have in the present day. This chart needs to morph into something more like this. Very, very similar situation here. Here's November 1st of last year. Look at the ratio of economically sensitive or opening friendly airlines relative to the NASDAQ composite. It goes almost straight up, and then it rallies into March of 2021 at point A. Present day really doesn't look anything like that. The ratio's making a new multi-month low. And if we look at the rally off of the low in 2020, so let's look at the move from a properly labeled point A here to point B here. If this uptrend were intact, we would expect to retrace somewhere between 38.2, 50, and 61.8% of this A to B move here. Right now, we're below the 61.8% retracement. That doesn't mean this uptrend attempt is doomed. It just means the probabilities are starting to deteriorate, just as breaking this upward sloping trend line tells us basically the same thing. When you see a move like this on a shorter term time frame, really what we're trying to do as asset allocators is try to determine, is this a counter trend move within the context of an existing downtrend, or does this look like a new trend, a new long-term uptrend? And to help us with that, we can look at longer-term charts. So this is the airline index relative to the NASDAQ composite. If we look at a longer-term chart of the same airline index, XAL, relative to the S&P 500, it's very, very difficult to say that the longer-term trend going back to, let's say, 2014 is up. So right now, this looks like a counter-trend move within the context of a downtrend. Is it possible that it morphs into something more like this, where airlines could outperform for several years? Absolutely, positively, yes, it's possible. But right now, we have a ratio that's below a downward sloping 50-month moving average. All things being equal on our time frame, we'd prefer to invest in things that are above an upward sloping 50-month moving average. A couple of relevant points here with the small cap index. Small caps have been consolidating, and also they got extended from an upward sloping 200-day moving average. This looks like normal consolidation, and we're still consolidating above that 200-day moving average. That would tend to be good for stock market bulls because we never rolled over during the September-October correction, and we held above that upward sloping 200-day in red. However, a lot of indices have now broken out. So it tends to be negative for small caps. They still look like laggards. Let's look at the same index, but at the bottom, let's put small caps relative to the S&P 500. Here's that consolidation that we looked at. This is small caps in isolation still up here, but this is small caps relative to the S&P 500. You can see they've been underperforming since March of this year. So all things being equal, you would prefer to have a higher allocation to small caps in here when they're outperforming, and a lower allocation or no allocation to small caps in here over the past several months while they've been underperforming. It's a little bit of a breakout attempt look here, but two things have happened. That breakout attempt on a relative basis looks like it's failing at this point. And number two, the S&P 500 has gone on to make a new all-time high, and the small cap index as of October 28th was still below this June high here. All of this is subject to change, just as it changed here in November of last year, but we really don't have evidence of a change yet. And if we look at small caps, IWM in this case, ETF relative to SPY, the longer term trend, 50-month moving average on a multi-year chart, we have price or the ratio below a downward sloping 50-month. This is starting to look somewhat like this false breakout here and this false breakout here. As of October 28th, it also looks like we're trying to print a lower low here relative to this low, but we'll see how it shakes out at the end of the month. Very, very similar situation here. As we said in a past video, for us, it's easy to own mid caps and small caps in here while they're adding value in a counter trend move because it's possible the trend's going to flip. But once they start to underperform and you have an underperforming asset here that's in a long-term downtrend, it gets very, very difficult to justify having some type of exposure or an overweight to either mid caps or small caps. If the present day chart on the right side of your screen morphs into something more like this on the left side of your screen, be more than happy to up that allocation or add to an allocation. Similar situation here. This is IWM, small caps relative to the triple Qs or the tech-heavy NASDAQ. Clearly, we're still in a long-term downtrend. In fact, this rally here couldn't even get back to a downward sloping 50-month moving average. Some signs of consolidation down here? Yes, that tells us to keep an open mind about eventually a flip, but we don't really have any evidence telling us this long-term trend has changed. Let's call this mega caps, the S&P 100 relative to small caps. Ratio consolidates sideways in here for roughly 16 years where my cursor's moving around. This looks like a bullish breakout here above this level. Then it looked like a failed bullish breakout, but now this is starting to look more like a retest of this breakout here. The chart in front of us is indecisive, something we have to respect. But right now, we've got a full-bore bullish look still in favor of the S&P 100 relative to small caps. We have a ratio that's rising and above a 50-month moving average that's rising. All of these charts on multiple time frames say trade the chart in front of you, which we're allocated to this chart here, but also maintain that maximum flexibility that tells you don't bet on this holding. We really don't have a resolution yet. It still leans towards the mega caps over small caps. but we really need to get some distance above this base. Very, very similar situation here. Now we're looking at mega caps relative to RSP, or the equal weight S&P 500. And this can be a good way to make decisions. Right now, OEF appears to be better than IWM on a long-term basis, but again, somewhat indecisive. How about OEF relative to RSP? Similar situation, maybe better, because when we came back here, we held above an upward sloping 50-month moving average, and we're holding the breakout above this level over here back in 2009. Compare the look in the present day. We came back to an upward sloping 50-month, and now we're rising again, possibly trying to print a higher high here relative to this high in October. That looks a lot different from this flip over here in 2009 that favored RSP, where the ratio was below a flattening and rolling over 50-month moving average. From a long-term perspective, the chart in front of us still favors mega caps over the equal weight S&P 500. Then on a long-term basis, if we look at RSP relative to SPY, we still have a ratio that's below a downward sloping 50-month. This looked pretty good here, but right now it's looking somewhat like a false move. If you're an RSP bull, you'd really like to see this ratio get out here, and you'd like to see this 50-month turn up. May happen soon, hasn't happened yet. And here we said OEF looked better than RSP, and here we said OEF in its present form on a longer-term basis looks better than IWM. But OEF can't keep up with SCHG, which is large cap growth. S&P 100 megacaps are still clearly in a longer-term downtrend relative to SCHG. This is OEF divided by SCHG as of October 28th. Looks like it's trying to print a new low relative to the ratio back here. Similar situation here. Until proven otherwise, regional banks relative to the S&P 500 is still in a downtrend. If you're a regional bank bull, in terms of overweights, you'd really like to see the ratio get out here and hold it. There's a weekly chart of growth versus value. During the session on Thursday, October 28th, growth was beating value for the week by almost 3%. You can see we've got that same thing here. We're trying to reestablish this bullish trend here that began in July by getting a bullish cross on MACD. We don't have that yet. And this bullish cross here really would be better than this one here because this one takes place below zero. A very, very strong leader would see MACD for the most part stay above the zero line, not oscillate above and below it. How about VTV, value relative to growth SCHG, for the month, October 28th, and it's not month end yet, down 2.56%, so value underperforming growth, and you can see the longer term trend hasn't flipped yet. And this speaks to a lot of themes. If interest rates are rising, typically value is supposed to outperform growth. So if you think we're going into hyperinflation, it's very, very difficult to align that with the look of this chart, and it's very, very difficult to align that with value that's underperformed growth by 2.56% during the first 28 calendar days of the month of October. I've covered this many times. There's no real winner here, especially looking back to, let's say, early 2020. This is the equal weight S&P 500 relative to the S&P 500. This chart is used for asset allocation decisions. What sectors are leading? Which ones are lagging? It's very, very difficult to get excited about anything in terms of an overweight, any ratio that's below the June 2020 high, and that's still the case for RSP. It's very, very close to it, just like it's very, very close to a 200-day moving average. So the intermediate term battle is somewhat mixed. The longer term battle is pretty clear. Right now it still favors the traditional SPY, or the traditional weighting in the S&P 500. This is calendar year 2017 here. If you're an RSP bull, you'd really like to see this ratio get into this area here. And that absolutely may happen, but right now we're below where we were earlier this year, and we're below where we were in June of last year. This would be the constructive thing in terms of keeping an open mind. We do have an upward sloping and turning up 200-day moving average. A lot of indecisiveness in here, and when that's the case, what do? We stick with the long-term trend until proven otherwise. What this chart is really telling us is you really don't want to be making, in terms of the way we do things, big bets on sectors at this point. You'd really rather make a bigger bet on the general market. Why is that? Because we're still checking a lot of bullish boxes relative to the longer-term secular bull thesis. And if the market's going to go up, we want to make sure that we're not getting too cute with asset allocation decisions and getting stuck in something that might underperform. And we're right about market direction. The S&P 500 rises, but our returns are disappointing because of asset allocation decisions. So until these indecisive looks break, number one, we'd rather own more of the market itself. Number two, we'd rather own more of things like RSP, SCHB, and even something like a VTI, rather than trying to make heavy bets on individual sectors. And if we're going to do that, we want to do that in areas where the long-term trends are favorable. In this case, if you flip it, that would mean we would still prefer to own growth over value. But this look in here is telling us we don't want to make any assumptions about what the future looks like. A move into this area here, and a lot of things can change from an asset allocation perspective. The market tends to get very short term in terms of its focus. Right now we may be hearing that consumer discretionary is the leader. Well, it's somewhat difficult to say that consumer discretionary is the leader when the ratio is still well below the high that it made in October of last year. A real leader would be up here. And it may get there, but right now it's got a hurdle here and a hurdle here. So rather than try to decide what sector when we have somewhat of a mess like this, we'd prefer to give a heavier weight to the market itself until we get clearer and stronger and more well-defined leadership. Back to the hyperinflation, inflation, and interest rate topic. October 28th, the long-term trend in rates is unequivocally down. In fact, interest rates are still lower in October of 2021 than they were in March of 2021. We haven't even exceeded this high here. If the market is concerned about hyperinflation, it's pretty much a given that interest rates are going to get up here. They're going to clear, the 10-year yield's going to clear 3%, and it's going to hold it. Right now, we're well below this downward sloping trend line. Another point, this peak here in 2018, interest rates plummet down to the low here in 2020. We've only retraced and stalled below the 50% retracement of this A to B drop here. So right now, this looks like a normal retracement within the context of this downtrend, and this downtrend is part of a longer downtrend where interest rates, for the most part, are making a series of lower highs and a series of lower lows. Here's another chart that somewhat refutes the inflation story or the hyperinflation story. For several months now, the ratio of materials, so input costs, let's think of that, relative to boring treasury bonds, IEF, that are typically the last thing you would want to own in an inflationary or hyperinflationary environment, this ratio has failed to make a new high since March or April of this year. You can somewhat make the argument here, inflation concerns, hyperinflation concerns are higher than they are on October 27th. Similar situation here. You would think if everything was flipping, that materials would be leaders instead of laggards. We know the S&P 500 has made a new all-time closing high since the low on October 4th. Here's materials XLB. On October 26th, we were below the high that was made in August of this year and below the high that was made in May. Same thing with equal weight materials. This is a laggard look, not a leader look at the present time. So the look of this chart here, the look of this ratio here, and the look of this chart and this chart tends to align with rather than contradict the information contained in this video that you can find by Googling the title on your screen. Is it possible that all of this changes and we do move into hyperinflation very, very soon? Absolutely it's possible, but the chart in front of us really just doesn't align with that at the present time. That's where maximum flexibility comes in. You're not defending the position of the present day chart. You're analyzing the present day chart. This doesn't look like hyperinflation. This doesn't really align with stagflation, nor do these charts in their present form. And if we're expecting the stagflation, the labor market really doesn't look anything. We don't have the stag part for the economy yet. So high inflation and a weak economy would increase concerns. You can make an argument a lot of these consolidation looks are somewhat tied to the Delta variant or concerns about the Delta variant and possibly a return to a situation like the left side of the screen. You can also make an argument that a breakout like this and a push in the S&P 500 to new all-time highs is related to decreasing concerns about widely available data and improving data on the virus. From Fidelity via Bloomberg, the immunity rate, which is people that have contracted the virus and people that have been vaccinated, that immunity rate has reached 71%. You can see the rise here on the larger version of the chart. Here's an updated version of our very, very long-term stocks versus bonds. Think SPY relative to TLT. This is the year 2000 where my cursor is. Looks like now we're going to exceed this high here from the year 2000, 1999-ish, Q4 of 1999, at the end of October 2021. The longer a market goes sideways, the bigger the move that you can expect to get. And all of this aligns nicely with the demographic analysis that you can find by Googling this title here. And compare and contrast higher highs here. You get a recession in the year 2000, the ratio rolls over. Financial crisis, this is what the ratio looks like here in 2007, 2008, into Q1 of 2009. This look here and this look here, pretty much the polar opposite of this look here. Thus, this really doesn't align with the stagflation theory either. Stagflation speaks to increasing odds of a recession. We did get a recession in here, and we did get a major recession in here, and we did get a short-term recession in here. Thus, when the ratio is moving down, that tends to correlate with recessions. Recent months, the ratio has been moving almost straight up and is trying to hold on to a very significant bullish breakout. The left side of your screen shows some new inflation-related data that was released on Friday, October 29th. This is noteworthy. Do we have inflation in the present day? Absolutely, positively, yes. Do we have evidence pointing towards hyperinflation? We don't. Not at this time. Very, very difficult to say that consumer expectations for inflation rising 2.9% over the next 5 years, and that's a figure that's down from the 3% level in September, that would qualify as hyperinflation. Also, thus far, earnings have come in better than expected. As always, the commentary in this week's video is based on the charts in front of us. If the charts change, we have to be willing to reassess the probabilities. And we all know the only way that we can do that properly is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.